Understanding value chain financing and the key players is essential in developing a successful and profitable strategy for financing agriculture. Value chain finance aligns incentives and shares costs and risks with agribusiness partners operating in the same chain. The model has proven to be a good way for banks to finance small producers, clients they typically would not finance individually. How does value chain financing work? VCF is based around an aggregator or off-taker who has a good relationship with a large number of small suppliers. An off-taker can be a farmer cooperative, a processor, or a trader. In most cases, the off-taker is already providing finance to its suppliers. The HDFC dairy value chain is a great example of this method being used successfully. In this case, HDFC used the model to finance individual milk producers with existing relationships within the milk value chain. The chain begins with HDFC working with milk aggregators who serve as business correspondents to facilitate delivering cattle loans to farmers. These aggregators, who already have a supply contract or off-taker agreement at a fixed price with individual milk producers, farmers, and the milk processing company, then handle the loan origination and application on behalf of HDFC. HDFC then provides the loans to milk producers based on a first loss deficiency provided by the aggregator and a cattle health certificate from an approved vet. During the loan period, it is the aggregator's responsibility to monitor the farmers, to ensure repayment and update HDFC. Then once the farmer delivers the milk, they collect the repayments on behalf of HDFC and pay directly into the farmer's HDFC account. This allows HDFC to ensure that repayment comes back to them directly. VCF is a way of creating an alliance or partnership with the off-taker based on a win-win proposition. The off-taker benefits as they are only required to take the small risk of providing the first loss guarantee rather than the larger risk of directly financing suppliers. This arrangement also frees up capital for the off-taker, as they no longer need to utilize their funds for financing of their suppliers. For the bank, it limits risk exposure and widens the client base while minimizing transaction costs. There are also two key factors for success and risks to be aware of. The company's financial situation. Here, the typical tools for credit and business quality analysis apply, and the strength of the off-taker's relationship with their suppliers and their track record for success. Value chain financing is a great way to share risk as well as enable and provide financing to clients that would otherwise be unable to receive it.